All right, good evening and welcome to the August webinar. We try and do this every month on a topic relevant to Australians living in America or Americans living in Australia. I'm Ashley Murphy, the founder and principal of Arete Wealth Strategists Australia, the only registered investment advisory firm that focuses on this particular niche. It is also worth me mentioning there is a difference between what's called international financial planning and cross-border financial planning. International would be that if you're from any other country other than the US, you're going to have a list of common issues and problems. Cross-border advice means one is actually schooled and educated in both countries' financial systems, as I am. I have a graduate diploma in financial planning in Australia, and I'm a CFP in the US. I'm also the founder of the Global Financial Planning Institute, although that's a conversation for another time. Okay, tonight's webinar, as you can see right here, it's about the Secure Act. Of course, this doesn't constitute personal advice to anyone. I would strongly encourage you to seek counsel of a professional advisor, estate planner, or CPA as you consider the information that I'm going to go through here. Here's a nice photo of me from a couple of years ago, a little bit about my background. I have been a regular conference speaker, UC Berkeley Extension adjunct professor, quoted in the Wall Street Journal, Financial Advisor magazine, et cetera, et cetera. And let me see, anything else worth mentioning here that I haven't already mentioned? No. Clients, issues we assist folks with, as you heard me say, Americans in Australia, Australians in America, with all these sorts of issues. And with that, I'll get straight into it. So tonight's presentation, we're going through the Secure Act. Came into effect late last year. First, we'll be talking about the benefits for retirement savers, for small businesses, of course, but mostly this will be to do with strategies to get around what we see right here. The goodbye to the stretch-IRA. That's what people really think of when they hear of this Secure Act, and because that's really the most significant thing for the most people. And the various strategies that can be employed to deal with this change. Excuse me. Overview of the Secure Act. Okay, so here we are. They're setting up every community for retirement enhancement, passed late last year as part of a larger federal spending package. What did it entail? Well, really a whole bunch of different things for different folks, small business owners, and the retirement plan changes that we'll talk about in just a second. So what do we see here? For retirement savers, mostly later RMDs used to be age 70 and a half. Now we're looking at age 72, although there have been some changes to contribution ages, which we'll look at in just a moment. So no age limit, that's what I was just mentioning, meaning if you have earned income, very important, it has to be earned. It can't just be passive income. That would not qualify. There would be no payroll taxes paid on that income. You're able to make that contribution to any age. That's not as glamorous as it may seem. While you will get tax deferred growth throughout your lifetime, do recall that what the government giveth, the government taketh away. And so there are required minimum distributions whereby, depending on a certain age factor, and that's essentially your life expectancy, you will be required to distribute an amount from that account, and the amount that's distributed is ordinary income taxable. Ordinary income taxable, that means it's subject to the marginal rate brackets, which are a little bit lower with the Tax Cuts and Jobs Act until 2025. We'll talk a little bit more about that when we get to the Roth IRA conversion strategy a bit later. So overview, continuing with the overview of the Secure Act here. A couple little tweaks around the edges to promote retirement savings, really nothing substantial. Now they've got to, on the statement, they've got to talk about how much your balance equals in terms of income over a lifetime. I think that's pretty handy because the number of times I've encountered, good evening, Mr. Bressy, the number of times I've encountered situations where clients say, well, I'm in good financial shape. I've got $500,000 for my retirement. I often think to myself, as a rule of thumb, this is something that a financial advisor will use. They will say, the rule of thumb is 4% is what is thought to be a sustainable withdrawal rate that one may take from a portfolio. The trouble with $500,000 is that 4% of that is $2,000, and that is, is $20,000, and that is not going to be a particularly healthy income over the course of one's life. So you can see, using that 4% rule, and of course with this new requirement that this lifetime income amount be printed on statements, it will help people just a little bit more to shock them into being properly prepared for retirement. When designing a 401k plan, one may now include automatic step-ups in contributions up to 15%, used to be 10%, and now the rules have come down a little bit for part-time workers where they may be eligible for plans. So that's great. What else has happened here? So there's been changes with regards to small businesses making the plans more affordable. The way in which they're doing that is they're throwing money at business owners. Remember, for folks in Australia, they may not know this, that unlike superannuation, the 401k plans and certain other simple IRAs would be another example. These are plans that are discretionary. If your employer does not offer them, then you are limited in what contribution you may make to your retirement account, and thus receive a tax deduction. Benefits to small businesses. Here's another one. I thought twice about including this. If you're a business owner, this may be relevant, so probably not to a lot of folks out there. But a MEP, two rules, two things changed there. Now you don't need to have as strong an industry affiliation, and nor does the bad apple rule apply. The bad apple rule was essentially if someone in the MEP was not totally on the up and up and compliant, then it could spoil the whole plan. Now that's no longer the case. So I would still struggle to think of a time when I would really recommend this, mostly because I'm a big believer in 401ks. 401k profit sharing plans where it's custom designed to the owner's situation. And with a MEP, you're obviously not going to get that. You're going to get whatever the whole group of employers has. Okay, goodbye stretch IRA. This is how things used to be, and this is what I think most everyone came here for this evening. So it used to be that when someone passed away and an account was distributed, that for non-spouse beneficiaries, they could take that distribution over the course of their life expectancy. Now, remember the rules of what I was saying before. With an IRA, it's going to be ordinary income taxable on the US side. And so it is also for the beneficiary of such an account. Let us look at this in a little more detail on the next slide here. Okay. So then here's what's changed. The most substantial change that affects the most number of people, and hence why we'll be spending the most time dealing with this particular issue. If you have a non-spouse beneficiary, or even a spousal beneficiary where there's a 10-year greater age gap, then the rules are looking quite a bit different. So instead of taking it over someone's life expectancy, where you could take an itty-bitty amount during someone's peak income earning years and thus not force them up into a higher tax bracket and see a greater proportion of that account distribution go off to our friends at the IRS, now you don't have the choice. And the reason why this really bites is because when you think about the typical generational difference between those that are passing away and those that are inheriting, typically we're going from folks, say, in their 80s, 70s and 80s, predominantly, given the average life expectancy in the US being age 78 and 79 for males. Given that it's mostly going from folks that age down to folks in their 50s, you're seeing people receiving it and being forced to take that distribution in their peak income earning years, as opposed to being able to defer it to a later date. There are a couple exceptions, as you can see here. And here's our friend from the Congress being so kind, reaching into the pockets of the IRA beneficiary. We've got to keep this stuff light, otherwise it can get pretty dry out there for people. The 10-year clock begins when a child reaches age 18 in most states. You heard me say this a minute ago. This is really where it bites, is you're getting hit with this forced distribution over a shorter period of time. That's what it's all about. And indeed, if you've stated a trust to be the beneficiary of your IRA, then it may blow up the whole point for establishing the trust in the first place, because as you'll see in our flow chart coming up, that is not exempted from how these the rules apply here. So let's start. This is obviously from the American Institute of Chartered Practicing Accountants. First we have, is the IRA owner living? Well, they're really not going to be distributing it, to a beneficiary if they are alive. So you can see we're really using the standard rules in boxes that are yellow and blue over here. So are they the sole? Is the spouse the sole beneficiary? No. Well, in that case, we're just using that individual's lifetime table. Is the spouse more than 10 years younger? Yes or no, it doesn't really matter. In any event, it's either the uniform table, or even better is the joint and last survivor table, which means the younger spouse's lifetime. So it could be stretched over years and years. I guess the example of Anna Nicole Smith comes to mind when you think of a big age difference between the deceased and the beneficiary, and the age span. Sadly, she didn't get to enjoy all those years of distribution. So is the IRA owner still living? We've got four major categories here: either a trust, the estate itself, meaning there was no beneficiary really declared, the spouse, or the non-spouse individual. In most instances, in 90% of instances, it's either going to be here the spouse or the non-spouse individual, i.e. the children. Spouse or non-spouse. Okay, let's run through this. Is the IRA owner living? No. Okay. Well, is it going to the spouse? Yes, it's going to the spouse. Does the spouse transfer to own IRA or treat as inherited? Really, it doesn't matter. They can take their applicable RMD, and then it's really taken over the course of their life expectancy. Should they pass away and it goes to the kids, okay, back to step one. Is the IRA owner living? No, not going to the kids. Non-spouse individual, are they disabled, chronically ill, or not more than 10 years younger than the IRA owner, or a minor child? No, there you have it. This is where it catches most folks right here. 10-year rule applies. Alternatively, if they are less than 10 years younger, or a minor child, then it's based on the child's life expectancy until they reach the age of majority, which you heard me say earlier. Trusts, we might see this happen, but again, mostly there's no way out of that. You're going to fall into the 10-year rule. What is the takeaway from this slide? Without belaboring the point much further, I would say you're to a non-spouse beneficiary, or even a spouse beneficiary where there's more than a 10-year age gap, you're looking at the 10-year rule. Okay, so strategies for getting around it. My favorite go-to strategy is this. And before we get into it, I do want to say how much a believer I am in tax planning, thinking about the future and what bracket you're going to be, what your average rate's going to be, what your marginal rate, what marginal rate you're going to get kicked up into being. That's really, really important. And as you're about to see here. And why is that? Because with Roth conversions, you can see that if you're going to be in a lower tax bracket, if you plan ahead and you say, gosh, my Social Security doesn't start till this age, the company pension doesn't start till this age, wow, that's really going to kick me up from, say, the 12 to 22% bracket. Gosh, a 10% marginal rate increase at the federal level. That's not going to be pretty. What should I be doing now while I'm in a 12% bracket? Gosh, I could be paying a little bit of tax and do Roth conversion. So the Roth conversion itself is a taxable event. No one likes to pay taxes, but as it was Benjamin Franklin who said, there's only two things in life, death and, that are certain, death and taxes. You're going to be paying those taxes anyway. And if your Social Security and pension are kicking in, then it's almost certainly going to be at a higher rate. the point that I was making earlier is that the Tax Cuts and Jobs Act of 2017, that provides a reduction in marginal rates that expires. It expires in 2025. So we've seen some minor reductions. What is now the 12% bracket will revert to 15. What's now the 22 will revert to 25. So we have some minor reductions, and I would say historically low. That is a bold proclamation for me to say, but we've all seen the news. We all know there's a global pandemic. We all know the incredible debt that's been added to many federal governments around the world, or to most, if not all, federal governments around the world. And as such, we can be pretty confident that taxes are going up. Now, does that necessarily mean marginal income tax brackets, or could it mean a GST type tax? It could mean any number of different ways, but I would be stunned if I saw taxes going down from where we are today. Okay, so fill up those lower brackets, do the Roth conversions, and make sure you're making use, especially if you've got access to a 12% bracket, which for a married filing joint couple is, I believe, in 2020 below $88,000. Someone will write in and correct me there, I'm sure, but it's right around the 87, 88. You keep your marginal, your AGI, adjusted gross income, below that level, and you're looking at a 12% federal bracket. Okay, next strategy, leave the inherited IRA alone for as long as possible. This is probably my least desired strategy, and it's somewhat conflated with strategy number 3, which you'll see in a second. This is predicated on the belief that in the last year, you will be in a substantially lower bracket. Perhaps you have the flexibility in your financial situation to control for that, and the size of the account may make that strategy worthwhile. The idea here is you're getting as many years of that tax-deferred growth, and then in year 10, bang. That's when the beneficiary I'm talking about, not the original IRA account owner, that's when that beneficiary would take that distribution. And, of course, the full amount of that account would be taxable in that year. So it would be, if the value of the account was $100,000, it would be like receiving a $100,000 check, paycheck, and thus having to pay full marginal federal tax on that earned income. No payroll tax, but federal earned income tax. Strategy 3, spreading it out over as many as 11 years. Remember, this is to do with the first distribution comes in the year following the account owner's death. So when using inclusive counting, we see that it in fact can be as many as 11 years. Don't waste that first year. That's the point that I'm making there. Fourth, and I excuse me, I misspoke, but strategy 2 and 4 were the ones that conflated, not 3. Strategically timed distributions. This is where good tax planning really comes into it. So if you can model out what your AGI is likely to be over the course of your retirement from all your known sources, then you'll be able to partake in this. And you could say, well, gosh, we've got some big payment of a deferred compensation account coming out in this year, nothing hitting that following year, and then a pension turns on from the year following. So that would allow you to say, to really make the most of those lower income brackets and fill up your brackets by either taking it directly or doing a Roth conversion at that point in time. So here are 3 examples of where there might be life circumstances that might account for accelerating or postponing those distributions. Oh, the 4th one, excuse me. That's a more complicated situation, making use of a passive loss in the US. We've got a variety of different kinds of income, and earned income and passive income are completely different types. Disposition of a passive investment with suspended losses is suspected. You can only use a passive loss to offset a passive investment. So that's a very, very specific circumstance that would see that. Okay, strategy 5. This is really far out there, but the idea would be to increase the number of beneficiaries. So if you can't get more years, then you could decrease the total take going to the feds by adding more beneficiaries. Therefore, lower the amounts being received by each beneficiary is going to be commensurately lower by the number of beneficiaries. However, do keep in mind that receipt of income to minors is going to be subject to the kiddie tax, which is not pretty. It's essentially means the child is taxed at the parent's marginal rate. So that could be a case of being too clever by half. Strategy 6, we saw this, or I saw this more accurately, 3 weeks ago. I had the pleasure of attending a week-long virtual conference with the AICPA, and they were talking about this. This was a strategy that was in all the news, and that the idea is make a charitable remainder trust the beneficiary of your IRA. Yet again, that phrase I mentioned a minute ago, too clever by half, comes to mind, because the conclusion was only in a very small number of instances, once you factor in all the variables, does this in fact make sense. However, having said that, now that we're talking about charitable remainder trusts, as a general rule, I love them. I think they're fantastic. Maybe not as beneficiaries for IRA assets, but let's talk briefly about what it is. Charitable remainder trust works like this. You have a charity that you like, you want to support, you believe in their mission. You say, gosh, I've got a little bit of extra money. I would love to see my money go to that charity. Fantastic. Well, this is a remainder interest. This is getting deep into the Internal Revenue Code and how it all works. But a remainder interest is different from a present interest. You say to that charity, listen, I'd like to support you, but really not right now. You know, I've got the matter of getting through the rest of my retirement, and then whatever's left, I'll be happy to give you. But I really do need to take an income stream from my assets until then. So how about this? We'll set up a charitable remainder trust, and I will pledge to you these assets. You can take this account, but I'm going to need a 5% income stream for that, from that asset for life, and whatever's remaining, you get to take. I get a tax deduction for the remainder interest of that, and there are IRS tables that talk about how you would distribute that, and what the ending value of that account would be, and what that tax deduction would look like. You get the 5% discount all throughout, and then at one's passing, that goes to the charity of your choice. This sounds absolutely fantastic. And in the case of, I've had a client that I've been strongly recommending this to for years, and I think she's just about to go for it. She has low basis IPO stock in the company that she works in. We're looking at a 10x gain on the stock. And essentially her choice is to, and she lives in California, her choice is essentially to pay 25% of that. Let's call the basis of this position $100,000, 10x, $100,000 now worth $1 million. She's going to lose 250,000 of that, or close to 250,000 of that in taxes. So really, while she may see $1 million as being the value of that account, no, there's a liability attached to that in the form of tax. So really, she's only going to profit 750. She's only going to realize, I should say, $750,000 or slightly less from that transaction. So really, we should be thinking of that amount as what's going in her pocket. And then if she were to use that as part of her portfolio, she's going to have to pay taxes all the way along. Compare that scenario to scenario B, the recommended scenario, where, and she happens to be charitably inclined also, which makes it even better, she could donate the full $1 million, get a tax deduction for the remainder value, which is deemed, as I recall, to be about $200,000 from this lady's in her mid-50s. The remainder value is deemed to be $200,000. She gets a $200,000 tax deduction that she can use in her peak income earning years. She has the full $1 million working for her. She can then take a 5% distribution from that account. So let's call that $50,000 for as long as she lives. Beautiful strategy. That's the idea that we're talking about here, with the idea of making a charitable remainder trust the beneficiary of an IRA. There's more details to it, but it actually doesn't really work in the case of an IRA in nearly as many cases as you might think. As you see down here, point C, some result is a tax-deferred account that can create a lifetime stream of income to beneficiaries upon death. But in other words, it's pretty close to the stretch, but it doesn't end up being as good. And don't forget, this is where it's important to poke holes in academics that come up with nice sounding strategies like this. The lawyers that put these things together, they don't work for free, nor do the tax returns that need to be filed. They're not free either. So when you add in the admin costs, it begins to lose a little bit of luster. So going forward, conversations to review retirement account beneficiaries. This is what it's about. Changes to the post-death distribution rules will have a dramatic impact on many families. I would say for those planning inclined individuals out there, it's going to have an even greater impact upon the account holder because they're the ones that are really in the driver's seat to impact what goes to the next generation. There's no single one-size-fits-all strategy, and essentially designing distribution plans that capture income in the most tax-efficient years. And to me, honestly, that boils down to a combination of two strategies. So leaving the best to last, I'd say the Roth conversion strategy for the IRA account holder, being mindful of using up their low income tax brackets, and then B, for the beneficiary, engaging in tax planning, working with a financial advisor or a CPA to plot out what the next 10 years are going to look like, because there's not a whole lot else that you can do, and take a larger proportional distribution in your lower income years. So speaking of those lower income years and tax brackets, do go to arete-wa.com. That's Arete Wealth Strategists Australia website. We've got our 2021 key financial data sheet right there. So you'll have the US data and the Australian data available for you to use. Some other relevant white papers that you should really take a look at on my website. You wouldn't believe how frequently these come up. It's actually, I was speaking with a prospective client today, and both of them came up, both concepts. I said, my goodness, you wouldn't believe it, but I've actually spent countless hours and written white papers about these very topics. So if you could choose a country on earth, if all things being equal, ceteris paribus, as they say in Latin, all things being equal, where would you choose to hold an investment account? Probably the US, but we don't live in a vacuum. We live in a world of individual circumstances. So one's tax situation and legal residency situation will dictate that. That's the takeaway there from the pros and cons of the managed funds for expat investors white paper. And the PFIX is really about US citizens abroad and US tax residents abroad being mindful of owning foreign mutual funds or ETFs or listed investment companies, anything where 75% of the assets are held for investment purposes, or 50% of the assets generate what you heard me refer to before, passive income, investment income. It's going to be deemed a PFIC, punitive tax treatment. You don't want it. And there are ways of investing. Mostly individual stocks is the way to go to avoid that PFIC tax treatment. If you're interested in having a conversation with me, you feel like something I've spoken about tonight, a strategy here may be of interest to you and talking about in further detail, please come here, click on Get Started. That will talk a little bit more about who we work with, and here are my contact details. So with that, I'm going to open up the floor to questions on the Secure Act. We have a Q&A panel right here in the Zoom webinar. So let's take it away. I hope no one has any stage fright. Let me see here. I see there is one. Someone's written in the chat box. I can hear you. That's good. Okay, that was from a little bit earlier. Okay, great. George, love your expertise on tax planning. Thank you. What are the problems with making backdoor Roth IRA contributions if a person ends up moving back to straight? That's really easy. If the problem is, I'll get to that, is okay, looks like you're under the answer here. If the problem is double taxation, yes, that the Aussie government could end up taxing the entire, it's not the entire account that they'll tax, both basis original after-tax contributions. Couldn't that problem be mitigated by withdrawing the basis prior to leaving the US, thus leaving only earnings? Yes, it would be. My understanding of it is slightly different from this. And that would be that the corpus, the basis of the account, would actually simply be your contributions and any employer contributions. If it was what's called a super backdoor Roth IRA, maybe that's an idea for another webinar, right? To talk about what's a super backdoor Roth IRA. It's probably not an idea now that I think about it, because it's essentially what not to do. The reason I never recommend these for the globally mobile, namely my client base, is because you will end up being double taxed, or you could end up being double taxed depending on who your CPA is and what their interpretation is of the treaty and so forth. My reading of it, I take a middle of the line approach, I think a very reasonable approach and defensible approach that the leading practitioners take, is that the basis of the account is your contributions and possibly your employer's contributions in the case of a super backdoor, as you heard me say a moment ago. Thus, only the growth would be taxable. If it's a backdoor Roth IRA, the contributions you've made are already deductible in the first place. So now you're taking something that was never tax advantaged, you're putting it into an account type that when it comes out, it's not going to enjoy the same tax treatment. When you have, okay, let me get clear on this for a second. There's an important middle step there. The non-deductible IRA has almost no benefit to it whatsoever. The backdoor Roth IRA involves two steps. It involves making a non-deductible traditional IRA contribution, which, as you heard me say, there's little to no benefit in doing that. And then immediately or shortly thereafter, rolling over that non-deductible contribution into a Roth. Okay, so you could do that. I would question the wisdom of doing it in the first place if you're thinking you might move back to Australia, because, as you heard me say a minute ago, the corpus of the whole thing is taxable. And then the corpus is, excuse me, forgive me here, I've said a few things inaccurately tonight that I've had to correct shortly thereafter. The corpus is not taxable, the growth is taxable on that particular account. For an individual returning to Australia who doesn't have any US personhood, then they may be in a position where they're able to get a complete step up in basis to the fair market value of the date they resume Australian tax residency on after-tax accounts. That would not apply to foreign retirement accounts, so thus negating the entire point of doing a Roth in the first place. George, I hope that was clear and not as clear as mud. Prior to leaving the US, leaving only earnings in the US. So yes, you could do what you're suggesting. That would be a way around that. Now that I reread the last sentence of your question, you could distribute it, yes, and then leave only the growth. I don't really know the point in doing that, and it seems like it would be less advantageous than what I described with just an after-tax account. Any other questions there? We'll give it another second. I won't presume that people were so entranced by my answer to that first question that there are no others. Thus, or the people held off from writing their other questions. Thus, I will presume that is it for this evening. That wraps it up. Thank you so much for attending here tonight, and I look forward to catching you all again next month. All righty, have a good night. Bye-bye.